Happy day. Welcome to M.O.P classroom. This is Dr. Radha Badrinath from the Department of Commerce, Accounting and Finance. Today's topic will be a brief discussion on working capital management. What is a working capital? Working capital is the capital required for the day-to-day working of the business. To express it as a formula, working capital is current assets minus current liabilities. From grade 11, we've been learning that current assets includes items like inventory, accounts receivables, cash in hand, cash at bank, investment in marketable securities, and current liabilities includes items like creditors, outstanding expenses, and bank overdraft. So these are all the examples of current assets and current liabilities. But what do you mean by current assets? Current asset is basically an asset that can be converted into cash within a period of one operating cycle. So this brings us to a new term, operating cycle. So what do you mean by an operating cycle? It's a time taken to convert the amount invested in inventory into cash once again. So suppose I buy inventory, I spend cash, how long does it take for me to get back that cash? That is only operating cycle. Let me explain it with an example. Suppose I own a retail store. Say I run a pharmacy. I'll have to buy medicines and stock it. The medicines that I buy cannot be sold immediately. It might take 10 to 15 days to sell it. So that 15 days is my operating cycle. Suppose I own a manufacturing business. I manufacture medicines. For example, you can take Cipla or AstraZeneca. They are into manufacturing medicines. They will initially buy raw materials. They'll buy chemicals. They'll have to process the chemicals and make it the end product. The end product can be as simple as a Zincovit syrup bottle, or it can be a Crozin tablet. So making this end product takes time. Then they will have to send it to the retail store, and then it has to get sold from the pharmacy. So the operating cycle is longer for a manufacturing company when compared to a retail company. Suppose I am making cars. For example, you take Maruti Suzuki, or you take Ashok Leyland. They make trucks. So for them, raw material itself has to be either imported, or they'll have to make some in-house manufacturing of auto components. Then they'll have to assemble and make the car or the truck, which itself might take 5 to 6 months time. And then they'll send it to the showroom. So when they send it to the retailer might not settle the amount immediately. Because when it comes to B2C segment, where you directly sell it to the consumer, cash sales is possible. But when you are dealing with a B2B segment, everything cannot be cash sales. It has to be partly credit. So you will have to give them time to make payment. So in my operating cycle, it's not just inventory conversion period, it is also debtors conversion period. So my operating cycle becomes lengthier. So now, what is the connection between operating cycle and working capital? There is a direct relationship. Longer the operating cycle, higher is going to be the working capital requirement, because when the period is long, my money gets blocked for a longer time. So that is the relationship between working capital and operating cycle as shown here. So here once again I have explained and I have given examples of different types of industries. So now we have understood what a working capital is and the relationship between operating cycle and working capital. So what is there to manage in working capital? So if you look at the objective of working capital management, there is no straight formula which will tell us how much has to be invested in working capital. It is all case to case. It is context based. So at any point in time, the financial manager should be able to justify, and he has to strike a balance between liquidity and profitability. When we invest in long-term assets like factory building, machines, infrastructure, it gives us return, it gives us profits, and this profit is fundamental purpose of forming the business. Whereas when you invest in working capital, when you invest in current assets, it does not give us any return. There is no profit at all. It is just idle funds. So though investment in working capital gives us liquidity, it does not give us profitability. So we cannot invest too much amount in working capital. And when we invest adequate amount in working capital, we have certain additional costs incurred. For example, space is a big constraint in many business these days. So if we are going to pile up stock, we need to pay extra storage costs, and based on the commodities that we are dealing with. For example, if I am going to deal with fruits and vegetables, and if I am going to stock them, the risk of getting perished is always there, that's inherent. And if I am going to deal with, say, mobile phones, then the risk of going outdated, obsolescence is always inherent. Similarly, when I give credit period to my customers, if I give them a very long rope and give them a long credit period, what happens is they might take me for granted and my risk of bad debts will increase. So these are all the additional costs incurred when we invest too much in current assets. At the same time, can I stay without investing in working capital? It's not possible, because if I do that, there is a risk that I might run out of stock. There is a risk that my customer will go to somebody else who gives them more credit period. So my investment in working capital has to be optimal. I should be able to strike a balance between liquidity and profitability. This is going to be the end objective of working capital management. Coming to the types of working capital, based on the concept, we can bifurcate working capital into two: gross working capital and net working capital. Gross working capital is nothing but my investment in the total current assets, whereas net working capital is current assets minus current liability. And when it comes to time, on the basis of time, we can bifurcate them into permanent and temporary. Permanent working capital is the minimum working capital required at any point in time, whereas temporary working capital is the working capital required over and above the permanent working capital, which is seasonal in nature. For example, if I am into manufacturing paper and making notebooks, definitely during exam time, say from February to May, when students take up exams, that's the time when my production and sales is peak. So naturally my working capital requirement will be higher during those times than the other times in the year. Now I thought I'll discuss a simple problem on working capital. Vinayak Limited is a trading company with the following annual data. Projected annual sales is 6,50,000 rupees. Net profit margin is 25%, so which means 75% is cost of sales. Average credit period to debtors is 10 weeks. Average credit period from creditors is 4 weeks. Average stock holding period is 8 weeks. Contingency allowance 20%. Determine the working capital requirement for Vinayak Limited. So this is how the solution looks like. Step 1, we need to find out the current assets, value for individual current assets. So we need to find out the value of debtors, inventory, or if any other value is given like cash in hand, cash at bank, include all that. Then we need to arrive at the total current assets or gross working capital. Let's call it A. The next step, we need to find out current liabilities, every individual current liability. We total it up and call it B. The last step is calculate the working capital, that is A minus B, current assets minus current liabilities. Some companies will want to set aside some amount for emergencies, for contingencies. If that's the case, we add that buffer amount also, and then we arrive at the final working capital requirement. So now the next challenge is, how do we arrive at these numbers? So for that, I've attached this work note. So first we find out the cost of sales, because only if we find out the cost of sales, we'll be able to find out debtors and inventory. So to find out cost of sales, the clue that we can use is profit margin is given to us. It's given to be 25% in the question. So net profit is 25% of 6,50,000, which is 1,62,500. As all of us know, cost of sales is sales minus profit. So sales of 6,50,000 minus 1,62,500, 4,87,500 is the cost of sales. Step 2, we'll find out each and every component of current asset. So debtors, it is given in the question that the credit period is 10 weeks. So if 4,87,500 is the cost of sales for 52 weeks, then for 10 weeks, what is going to be the amount blocked in debtors? So using the formula, we get 93,750 as debtors. Next, when it comes to inventory, it is given that the inventory holding period is 8 weeks. So again, using the same formula, 4,87,500 divided by 52 weeks into 8 gives us 75,000. Current liabilities, the same way, cost of sales by 52 into 4 weeks credit period extended by the supplier is 37,500. So once we enter that, current assets minus current liability is 1,31,250, and adding the contingency allowance of 20%, we arrive at the total working capital requirement of 1,57,500. Thank you. I hope you enjoyed learning from M.O.P classroom. If you enjoyed it, please like, share and subscribe. Thank you.